The market is showing a European banking crisis may be imminent, and Credit Suisse is right at the core of the problem. Is Credit Suisse the next Lehman Brothers? In my opinion, it might even be worse. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go right over some of these charts and show how insurance against Credit Suisse collapsing, going into bankruptcy, is exploding higher. Before we get to that, let's start with their share price over the past 52 weeks or during 2022. We go March all the way to today's date on the left. We go from 2 up to 10. So the 52-week high for the Credit Suisse share price, about $10.18. And as of yesterday, it got down to $3.52, down a confidence-inspiring 666. That is also down 65%. But that's not where the story ends. It gets a lot worse. Let's look at this next chart. Credit default swap spread. This is the price you have to pay for insurance if you hold the debt of Credit Suisse. Well, you don't have to hold it, but if you own Credit Suisse bonds, and if you want to insure that against them going bankrupt, you can buy a credit default swap. Again, it's basically insurance, just like your car insurance is protecting you from your car getting into an accident. This is protecting the bondholder against Credit Suisse going bust. And the spread is basically the price you're going to pay for the insurance measured in basis points. So here's a chart going all the way back to 2006 to today's date. On the left, we go from 0 up to 250. I want you to notice during 2008, the price of a credit default swap for Credit Suisse's debt was around 250. I'd also like to remind you that 2008 wasn't exactly an awesome time for the global banking system. You guys remember why, the GFC. But you'll notice that just as of yesterday, when the share price dropped down to 352, the price of the credit default swap or insurance against them going bust went all the way back up to where it was during 2008. Another very ominous warning sign from the marketplace. So this begs the question, is Credit Suisse the next Lehman Brothers? And over the next couple weeks, will we have a Lehman moment of 2022 taking us into the next GFC, global financial crisis? Step number 2. We now know the marketplace is warning us that Credit Suisse and other banks in the Eurozone could be on the brink of collapse. But what are the details? You can read the headlines from CNBC, Bloomberg, and the mainstream media and know that their share price is down significantly and the credit default swaps have spiked higher in price, indicating the risk has gone through the roof. But why? We need to understand what's happening on their balance sheets potentially so we can understand the probabilities of them actually going bust and creating a systemic problem like Lehman Brothers did back during 2008 and the GFC. So let's go over their balance sheet 3 different ways. And I am oversimplifying here to an extreme, but these are some examples of what could be happening on their balance sheet, which would lead the price of insurance against them going bust skyrocketing in price. So our first little oversimplified balance sheet here, assets on the left, liabilities on the right, and this is for the bank Credit Suisse. You can tell by the little red thing here. And their CEO is out there with his Swiss kind of mountaineer outfit, and he is yelling from the mountaintops. Or maybe he is yodeling from the mountaintops. Nothing to see here. Back in 2008, if you remember, Lehman Brothers CEO came out with a letter, I think to the shareholders and to the employees, saying, our balance sheet is as strong as ever. And 3 days later, they were completely bust. And it's rather an ominous sign that the CEO came out the other day and did the exact same thing. A letter saying that their balance sheet was as strong as ever. Don't worry about it. We're not even close to going bust. Nothing to see here. Just move along. So getting back to their balance sheet, let's say they've got bonds as assets and maybe some sovereign debt. We'll call them gilts from the UK. We know that they spiked higher just the other week, which caused massive problems with the UK pension system. All right, and let's say on the liability side, we have loans, meaning that they borrowed money to buy these bonds in the first place, and we have equity. So what happens if they take a loss on these corporate bonds they borrowed money to buy, and they take a haircut on the gilts they own because the interest rate goes from 3.5% up over 4% within the matter of a week? Now, usually they'd probably be hedged against taking a haircut or interest rates going up on the bonds they own. But this would be a hedge over 6 months. In other words, they probably would have been okay if the gilt, let's say, would have gone from 3.5% up to 4.25% over the span of 3 months, 6 months, a year. But when this happens in 1 or 2 weeks, they have no hedge for that, and it blows a hole in their balance sheet. So after this type of event, and again, I want to be very clear, I don't know if they have bonds on their balance sheet. I don't know if they have gilts. I'm just using this as an example so you guys can understand the concepts here. So after we have this financial event, let's say, they take a big haircut on those bonds, the gilts. So now those equal the exact same amount as their loan that they owe. And I know that they probably get a margin call, but again, we're just oversimplifying here. So let's say the loan they owe is $1 billion, and the value of their assets goes down to $1 billion. Now all of a sudden, they have absolutely no equity. Boom, they're bust. The second example we'll give you, they'll have mortgage-backed securities and let's say treasuries as assets, and liabilities, customer deposits, and equity. Well, let's say that the treasuries go down in price because the interest rates go up very quickly in the United States. Let's say on the 10-year, the 30-year, let's say they own the long end of the curve where there's a lot less demand than the short end of the curve with those T-bills because the short end is used as collateral. You guys know what that means from watching my other videos, and if you don't, no problem. It doesn't impact the overall concept here we're talking about. So if these treasuries go down in price, that would reduce the amount of equity. And you may say, George, okay, well, they're not in dire straits yet because they still have some equity to play around with on their balance sheet. But let's remember Basel III and all of these regulations that have been put in place since the GFC. This Basel III stipulates they have to have a certain amount of equity relative to the assets on their balance sheet. And it gets even worse for the banks like Credit Suisse because their assets are risk weighted. So remember, we've got mortgage-backed securities here. The regulators say, okay, you've got more risk with these mortgage-backed securities and a lot less risk with the treasuries. So if the treasuries go down in value, but the mortgage-backed securities, let's say, stay the same, for the sake of this example, this could put them into an extremely compromising position. Or, said another way, it could have the same net result of them going bust in the first example because the regulators come in and say, oh no, you're under this threshold, so you need to liquidate, or we need to put you into some form of bankruptcy to make sure that the depositors get their money. Then the third scenario is just a good old-fashioned hole being blown up in their balance sheet as a result of a loan going bad. So let's go back and remember, they loaned Archegos, or Archegos, I'm never quite sure how to pronounce that, but they loaned them $5 billion. It's actually $5.5 billion, but at the end of the day, with these banks, an extra $500 million here and there, it's just a rounding error, right? So this hedge fund or financial institution blew up, and therefore Credit Suisse took a $5.5 billion loss. So let's think through what's happening right now with the global economy, most likely going into a recession, and all the problems we see in Europe. So would it be any surprise for other loans that they have outstanding to financial institutions to go bad very quickly? If those loans go bad, it could put them in the exact same position as they were in the first example. So just to make sure we're all on the same page, assets, they've got a loan to, let's say, a financial institution. They have bank reserves, liability, customer deposits, equity. So if these loans go bust, now all they have are the bank reserves to back up the deposit liability, but they have no equity, which again puts them in the exact same position. So this could be what the market is telling us is happening behind the scenes on their balance sheet, as their CEO is coming out and saying that they've got a fortress, rock solid balance sheet. There's no chance of them going bust. Nothing to see here. And a couple more points I want to make. Remember, back prior to the GFC, they used mark-to-market accounting. At least the banks did in the United States. And this was one of the big problems, because when the price of those mortgage-backed securities they had on their balance sheet collapsed, and so did the asset side of their balance sheet, making a lot of those banks insolvent, but technically just on paper. So in 2009, they got rid of that rule. So a question I would have is, in Europe with Credit Suisse, are they using mark-to-market accounting? Because in the United States with our banks, we are not. So you see where I'm going with this. We could look at their balance sheet right now and it could look like this. Again, nothing to see here. But if you actually used mark-to-market accounting like they did when Lehman Brothers blew up, the balance sheet would go from this to this overnight. And lastly, you remember at the beginning of the video that I said this could actually be worse than Lehman Brothers in 2008. Why did I say that? Because if you look at the combined balance sheets of Credit Suisse and Deutsche Bank, and Deutsche Bank is having almost as big of problems in the market right now as Credit Suisse, but their combined balance sheets are around $2.8 trillion. Compare that to Lehman Brothers in 2008, which is about $600 billion. So think about the contagion that we had back then. Think about all the systemic risk in the banking system, and then understand that in Europe right now, it's 2, 3, maybe even 4 times worse than it was in 2008. And the most terrifying market signal wasn't with their share price. It isn't with the credit default swaps. It's the fact the Washington Post came out and said there is no chance that Credit Suisse goes bust. They echoed the exact same thing that the CEO was saying. And we know through studying financial history that this almost always is the kiss of death. Step number 3, what is the end game? How will this potential European banking crisis play out? The first thing that I want to highlight, and my good friend and business partner, Lynn Alden, points this out. She's pointed this out for quite some time. Lightning very rarely if ever, strikes in the exact same spot. Meaning that if you go back throughout history, we've had several financial crises, economic crises, but rarely have we seen the exact same thing 2 times in a row or within the same 15-year period. So it would be highly unlikely for us to have another GFC that was a result of the banking system. Now, I want to point out that it doesn't mean that we won't have an economic crisis that involves the banks, like Credit Suisse, actually going bust. The way I look at it, it's just like a dam, let's say the Hoover Dam. And back in 2008, it had a crack, which was the banking system, more specifically the euro-dollar system, the global monetary system, but I don't want to go down that rabbit hole. So let's just stick with the banking system. And that crack is what made the dam burst. Well, now we can have a different crack in the dam that actually makes it blow up or burst, while at the same time, we can see the exact same crack that we saw in 2008. And that same crack we saw in 2008 can lead to another crack forming, which is the crack that actually is the last snowflake that creates the avalanche, to use another analogy. Another thing we must recognize is the US banks are in far better condition as far as the strength of their balance sheets than they were back in 2007. Now, this doesn't mean they're out of the woods, because I'd remind you that now they're not using mark-to-market accounting. So if they were, would those balance sheets be as secure as they seem at surface level in 2022? I don't know. We'll have to wait and find out. But the best way I think I can help you get your head around the situation is to look at this inverted pyramid. This is how I always kind of see it in my head. You have the real economy at the bottom, and then you have this huge bloated financial economy that's sitting precariously on top. And this financial economy consists of a lot of different players, such as the banks, the hedge funds, the financial institutions, the corporations that play these financial games with their balance sheet, and then the central banks. And they're all interconnected. So if one has a problem, then it affects all of them that are in this financial economy. And since it's so unstable, it's just kind of teetering back and forth. If one little thing happens, the whole house of cards comes crashing down. Why? Because of the massive amount of leverage and debt in the system, not to mention the derivatives. The bottom line is the excessive amounts of risk that are in the system as a result of the central banks and the central planners coming in 1990s, 2000, and bailing out everyone. They never let any financial institution fail. This creates moral hazard. So if you're a bankster, or if you're someone in the financial economy, why wouldn't you take on an excessive amount of risk? It makes sense because you know the central planners will be there to bail you out. Another visual I can give you to help understand the current situation, and I use this example quite often in my whiteboard videos, so you might have seen it already, but it's worth repeating. In a healthy economy, you would have something that looks like this. You say, well, George, what on earth is that? Well, again, this is kind of how I see it in my mind. You've got this hot air balloon. We've all seen them on a Sunday morning throughout the country. And the balloon is really what dictates where the little basket that the people hang out in, where the basket goes. So if the balloon goes up over here, well, the basket is going to follow. This is the way it should be. The real economy should be the balloon, and the financial economy should be the basket. So really the only risk is if we have something happen in the real economy, then yes, it impacts the financial economy. But if we have something happen in the financial economy, it doesn't really impact what's happening with the average Joe and Jane in the real economy. Makes sense, right? But now we have this type of balloon, where instead of the real economy dictating what happens with the financial economy, it's the complete opposite. The financial economy is the balloon, and the real economy is the basket. And if any little thing happens in the real economy, it can blow up the financial economy and vice versa. So now it doesn't necessarily have to be a global financial crisis that makes the dam burst. It could be a global economic crisis, such as in energy, what we're seeing right now play out in Europe. It could be inflation. Therefore, those interest rates at the long end of the curve spike higher unexpectedly, and this impacts the balance sheets of all these players, just like we discussed in step number 2. Or it could be a good old-fashioned recession/depression that brings the entire house of cards crashing down. Lastly, I want to point out, like I said before, this is a result of the central planners making bad policy. And we can say it's the unintended consequences. But now these policy errors seem so egregious, they seem so stupid, that you have to ask the question, are these unintended consequences that we're seeing play out right now globally, and most specifically in Europe, or are they intended consequences? I'll let you be the judge. So the main takeaway from this entire video is the way the system, the global economy and the global monetary system is set up, it's in a very precarious, unstable position. And although we might not see another global financial crisis, because we have so many cracks in the dam that we can see in real time expanding and getting bigger and bigger and bigger, at some point, I think in the near future, in the next couple years, we will see a crisis, but it will be an economic crisis and maybe not a financial crisis like we saw in 2008. But the impact will be just as great, if not greater. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.